Okay, welcome to this episode of the podcast. We're happy to have you guys joining us for another episode of Talking the Markets. We've got Markets and Mayhem with us today. Very excited to hear your experience and your thoughts. And thanks for joining us today. We've got a little bit of time left for the stock market to be open, so thanks for carving out a little bit of time to join us on this.
Yeah, Jared, it's great to be here with you. I think it's an interesting podcast, and it's certainly a great time for us to discuss what's going on in the markets and the broader macro picture. And, afternoon trading, I got to say, it's not like it used to be. Outside of gold, the markets are just sort of chopping sideways this afternoon. So it's a great time to sit down and talk shop.
I agree. I agree. It seems like those last 2 hours or so is just anyone's guess at that point. So kind of have to be positioned for it. So that's great. That's excellent. So let's dive in. Now, you have been involved in the stock market since about 2005. Is this correct?
Yeah, I started trading with capital that I had saved, but the first trades that I ever did were actually during the dot-com boom. I
Mm.
borrowed a couple $1,000 from my dad. I went long Yahoo and I went long Amazon in equal size. And within about a day, they had nearly doubled. And that scared me because I said, wait a minute, I might be young and naive, but I know enough to know that if the markets really worked like this, no one would work an actual job. And so I told my dad to sell down both positions, and then I took some time away from the markets to learn more about how they work, to generate my own income, to pursue my career, and to start then building that capital. And I started trading stocks in 2005. And that was where I really started to cut my teeth on my trading journey.
Interesting. Interesting. Being involved in the early .com, I think people go kind of both directions or one of two directions on that. Either they're the bull market geniuses or they're people that say, like you did, something's not right. And so let's proceed with caution. And it's interesting. I feel like that's pretty timely. We're seeing quite a few, we're almost kind of creeping back into some of that meme stock territory on some of these names that nobody's been paying attention to. And so we'll dive into that in just a couple of moments because I think there's some great parallels there. But so going back to 2000, certainly the .com period, and then kind of really getting involved in kind of the earlier 2000s. What what things stand out to you kind of immediately that really kind of shaped your trading journey? What kind of made you decide what direction you wanted to go and how you wanted to approach this whole thing?
So I think the first thing that stood out to me is that a good narrative can drive things far well and beyond what anyone thinks possible. Looking back at the dot-com experience, as I was learning more about trading and how the financial system worked, it was a good exercise on risk management and also emotional management. Back then you could step into a taxi cab or go to get your hair cut, and people were talking about buying this dot-com stock or that dot-com stock. It was the talk of the town. And it was a very powerful contrarian indicator looking back on it, knowing that, boy, when everyone's talking about something, maybe that's a sign that you need to be a little bit more cautious. And of course, we've seen this replay time and time again. So that was one thing looking back on it that I learned more about the human psychology, the power of a narrative. When things get well beyond what's reasonable and starting to see some of the signs of it. And it was interesting because that kind of helped me to prepare for what was to come over the next several years. That's not to say I saw the great financial crisis coming in advance, but I started to see warning signs that made me uncomfortable, like going into a mortgage broker and being able to refinance or get new mortgages for a dozen properties, and all you have is a pulse to show for your ability to repay. That was a little disconcerting, as was some of the shakiness in the money markets over the summer of 2007, and the volatility in some of the Asian markets, primarily China and Japan, started to get me a little more nervous. But when I looked, and I was purely a technical trader at that point, when I looked at a long-term S&P chart, what I saw was we were getting back to the highs around the dot-com boom, and we were seeing resistance. It was like the biggest double top, potentially, obviously it hadn't confirmed, that I had ever seen. And so I just thought, you know what, instead of getting too greedy, let me just step out of the way. If we break above this top and we build some acceptance, I can get back in at a higher price. If not, I realize some capital gains here. I have some cash on the sidelines for a rainy day. And I didn't expect the whole financial system to come unglued underneath us, but certainly I did expect there to be some consolidation or potentially a correction from those highs. So I kind of let that idea from what I learned from the .com era that, yeah, the narrative can keep going, but sometimes when everyone's so certain about something, you need to be cautious. And at this point, everyone was certain that there were no risks in the real estate market. It wasn't a bubble and it was just going to keep going parabolic. And with everything I was seeing and what was necessary to keep that demand going, I started to get a little concerned. But the technicals were really what drove that decision.
That's interesting. The technical side of both the .com massive sell-off and then certainly 2008 were very interesting. Like yourself, I was a bit newer when 2008 hit. I mean, I'd maybe been trading for 5 years and investing and so on. But there was enough to identify there was a couple of signals, when we saw currencies kind of doing what they were doing and commodities doing what they were doing. I always remember, I try to gauge this, and I remember in early 2008, I was living in Los Angeles, and I went to a gas station, and I said to myself, did I just pay like $6 a gallon for gas, right? Which 2008 in the US, pretty expensive, right? I mean, that's kind of a Tuesday now, and obviously we're less than that, but I remember thinking to myself, this all feels wild. This all feels very crazy, and the charts very much confirmed so much of that. So speaking of 2008, you participated in that, you traded through that, and you came out profitable. Is that correct to say?
Yeah, it was a really formative era in my trading experience because, on the one hand, what is one thing that a trader really wants more of than the market often delivers? Volatility. On the other hand, boy, did we get that and so much more than anyone would have reasonably expected. I mean, I remember waking up on days firing up my trader workstation on interactive brokers, and there were major companies that were essentially bidless. I'm talking Exxon, Microsoft. You even come in Dow futures down 600 points, which meant a lot when it was trading around 7,000. And then
Sure.
the Fed would come in, there'd be an attempt at a stick save, maybe a 50 basis points emergency cut. Everything reverses the other way. Now Dow futures are nearly limit up ahead of the open. You've got this narrative. But what you noticed back then, and this is where my kind of looking at both macro and momentum started to really come together, was you started to see with each stick save attempt by the Fed and to a lesser extent on the fiscal side, there was a sellable lower high. And it just became so formulaic that for me as a technical and momentum trader, I started to have to pay a little bit more attention to the psychology and the macro driving these lower highs, which would almost always lead us to new lower lows or at least periods of consolidation. And so that was the other thing that kind of started to form in my trading brain. That part of me that looks for opportunities and tries to tune out everything else was this idea that the financial plumbing, monetary policy, and fiscal policy, all three played a very powerful role. But ultimately, the imbalances and the overall risks in the market, which I was learning more and more about. Talk about a quick study going through the great financial crisis with the
Sure.
global financial plumbing laid bare. There's no better way to learn about appreciating unrealized risk than that type of a situation. So I'd say that that was where, for me as a trader, I was getting more into options and forex and commodities. So you mentioned cross asset volatility picking up. I love that you mentioned that because that was also something that started to ring. And I was looking at oil hitting 130, 140 and going crazy, but I was also looking at gold and saying, boy, gold isn't telling us anything good right now. It's usually a measure of uncertainty and angst. And it was just flying back then before obviously things became unglued.
Yeah, yeah, that is so true. It's I remember those charts so well. There were so many telling signs, which brings me to, you said something interesting that you were during that time you were heavily momentum and technical in your trading. And for those that when we say technical, we're not just saying somebody that's very precise, right? We're saying technical analysis, right? So you're looking at trend lines, you're looking at support and resistance, you're looking at trends in general, right? You're trading based off that.
Yeah, I was basically putting a bunch of crayon lines on a chart and, really, and I don't want to dress it up because let's be honest, technical analysis works, but to a large extent, it also works because people believe it works and therefore they trade off of it, particularly things like moving averages and otherwise. I think technical analysis has a lot of value in trading. So don't get me wrong, but on the other side, I am perfectly willing to self-deprecate and say things like technical analysis is astrology for gamblers because it kind of is. And that's fine. We can't take this too seriously. But yes, that's what I was into. I was into finding momentum and riding it until it would reverse. That was how I like to swing trade. I'd also day trade in things like gold. I started to be a degenerate even pretty early on in my trading cycle in those shorter time frames, but I loved it. It was exciting. It was consistently profitable for me. I saw signs often in other markets that would lead to gold moving up or down. So for my short-term trading fix, that dopamine cycling trading that a lot of us get into early in our journey, gold was it back then. And the reason I mention it is gold hasn't been this exciting to trade since 2012, 2013. It's only in the last several years it started to come back and really be an exciting vehicle to express that in. And if there's any pure vehicle for momentum and psychological driven trading, it is gold. 100%.
Gold is, yeah, I mean, you're scratching the heavy topics right now. Gold obviously is on everybody's mind as it goes straight up. But before we get to gold, and I want to segue us into this gold discussion, do you think, and especially with something like gold that's had nothing but momentum and volatility. I mean, gold, come on. It's going crazy. It's doing some historic stuff right now. We're at historic highs. But if we take it back a step, in your early days of being a technical trader and how you've progressed over the last 20 plus years, how do you look at various analysis types? It seems like back, I don't know, 15, 20 years ago when we were both fairly, new in the markets, there was a lot of, you can't blend them, or you've got to really commit to something. And there was the hardcore technical community and the hardcore fundamental community and so on. And so how do you look at that now, as far as how you view markets through what lens or what lenses?
I love that question so much because I was fortunate enough to have some really great mentorship from people that were much more in the value fundamental shop early on, then later growth, then later talking to VCs and private equity and kind of learning how some of the investing strategies they do on the private side work. And so early on, there was a lot of that. I was very technical. And I was talking to these guys that ran a successful growing value shop. They didn't even look at charts. They're like, why do you? No one got real rich investing based off technicals. And I was thinking to myself, I don't know how true or false that is, but it certainly sounds like there's conviction behind it. And they certainly seem to do well enough just looking at the balance sheet and the earnings and the sort of trends that exist in the money rather than in the price discovery. And that really started to create a powerful itch in the back of my brain, that itch of curiosity. Here I am just staring at charts, putting crayon lines on them and, doing pretty well at my trading. But then I started to learn, there's a lot more that drives this market. Like, why are certain parts of the market leadership? Why are certain parts laggards? Obviously, you can look at the momentum, you can define where the leadership may be based on the momentum, but you may not be able to create a compelling narrative as to why. And so having learned from folks that were more on the fundamental side, particularly on the value side, it allowed me to open my eyes to what investors really look at. Because for the longest time, I was really just focused on trading and then taking excess profits and putting them into index funds and things like that. This opened my eyes to a whole other world, which is, what? The health of the company, the industry, the sector, the broader macro narrative all tie together and often can help you find some of this momentum in its earlier stages with the data to back it up.
that is a very good point because I think, like you said, the community has blended quite a bit. It seems a little rare that I see hardcore one way or another kind of people out there. And of course, there still are. The community's ever growing of traders and so on, and the way that we all communicate. But you really need to understand the whole picture and this kind of early 2000, because we're talking a time where retail traders could finally have, real good access to the market and this retail experience that's kind of happening. I manage a hedge fund and I don't work on the retail side, but I spent many years in that side of things, and it's changed quite dramatically. And so on that front, I mean, what would you say are your go-to kind of top, I don't know, 3 or 4 kind of metrics or indicators that make you excited about trading something, buying something, staying in something?
That's a great question. And first, I just want to go back a little bit to what you said about kind of where we are with retail on this discussion. I think that we have, and this touches on what you're saying about how everything's changed. We have the most dynamic and vibrant and involved retail community and trading that we've ever had. And a part of me really hopes it never goes away. We'll see what happens after an actual bear market, whenever that may come. But I love what this has become because it's just everyday Americans participating much more in trading, in investing, and really starting to see the value that can add to their lives and then expanding their own horizons. And if there's one thing that you have to do to stay alive in any business, but particularly trading and investing, it's being willing to keep an open mind and always learn new things as they are relevant to the market. For me, and this touches on your next question, that is all about options right now. For me, one of the things that gets me the most excited about a opportunity to trade, whether it's a day trade or a swing trade, is looking at the flow and the various options exposure levels. So much so I've actually built tools specifically for this, for stocks, for ETFs, for the indices and how they translate into the futures like the S&P and NASDAQ. The other area that gets me excited about looking at these opportunities over the longer run is the underappreciated or mispriced macro and or fundamental narratives, because I do think there's a confluence in there for the swing trades and the investments that sometimes gets overlooked. And maybe it's that early value schooling, because these were folks that like to find overlooked opportunities that they felt had the ability to turn around, become something bigger. And if and when they did, these could be 5 or 10 bagger type of plays in a matter of years as the
Sure.
market started to recognize their value. So that's kind of ingrained in my DNA, looking for the overlooked, being a bit contrarian on the one hand, but also when it comes to momentum, just holding your nose and riding the momentum as it may exist. So another thing I really love to do is backtest and create signals. Signals excite me because you have some degree of data that is likely to lead you to a better probability of success. But more importantly, you have clearly defined areas of potential reward and risk. So you can manage that trade with a lot of emotion taking out of the mix. Because if there's one thing that hurts a lot of traders, and we both know 90% of people don't make it in this game. After a year or two, people just drop out because they get hurt. Their expectations aren't realistic. They're not managing risk or otherwise. One of the reasons I do what I do is to try to turn that around. And one of the ways I think we can turn that around is being more systematic in our approach.
That is such a great segue into the next part that I want to talk about. But I want to go back a little bit here. When you're looking at options, and options have been an interesting thing, right? I think obviously options have picked up a lot of momentum in the last several years, and certainly people that need that dopamine hit, that want to trade the zero DTEs, are just real excited about all that, right? And that's great. I actually know a few traders that have had quite a bit of success in that alone. That's not necessarily my style, but there are so many interesting metrics within options. And when you say you look at some of the option flow, are you looking at, say, open interest? Are you looking at volumes? Are you looking at spreads? What implied volatility? What kind of gets you going on the option side of things?
Let's talk about a few examples because I love that question. And it gives me an opportunity to speak towards some of these metrics that I really like to focus on. The easiest cut and dry example that I'll start with is looking at the most active strike in the S&P 500 index options. And so what I've done just for this very simple metric that tends to be market moving, particularly on green days, is I've created a tool that identifies the four most active strikes, the two most active calls and the two most active puts. I call the most active strikes hot, so the hot call, the hot put, and then the second most active strikes warm, so the warm call or the warm put. On a trading day where we have, let's say, a decent opening range in the S&P 500, so I like to look at the 20-minute opening range. For me, a decent and open range with the price where it is right now is 15 or 20 handles. So let's say we have a decent opening range. For those that don't look at that, that suggests you have more potential for dynamism, wider ranges in the overall price discovery that the market could have. Then let's say you have a break to either side, ideally the upside. I find upside trending days are easier to trade. When you have that break to the upside, you build some acceptance above the top of the opening range, then I really start to look at the S&P options flow. If the two most active strikes, the hot call and the warm call, combined are trading with 30% or more excess of volume, the more the better, than the top two put strikes or the warm and hot put, you're often going to have a day that trends right into the hot call. I mean, almost to a tick when you have that kind of setup. And again, the more volume, the more likelihood that that outcome is going to come to fruition. So, put very simply, and this is a very, very kind of base layer version of what we look at. This is one strategy that can play out well for people that are day trading, but, and I know it sounds funny to say this for day trading, but have a longer time horizon in that day trade. So instead of scalping 5 or 10 ticks, or very small amounts of movement, you're looking for a trend day. You're looking for basically taking the bulk of that move and booking that as a gain rather than trying to micro trade every little candlestick move that may happen. For those types of traders, the longer time horizon day traders, as it were, that's a strategy that can bode well. But let's zoom out a little bit because you talked about other areas of the options. So we like to look at the Greeks. And so I built an inference system that looks at where dealer positioning likely exists, categorizes it like things, say, a call wall or what may be formidable resistance overhead, or a put wall, what may be formidable support below, based on the implied dealer positioning from customer order flow at those levels. We'll also have key gamma levels. Gamma 1, for example, the largest level of gamma positioning on the chain, can be a bit of a magnet. When price gets close to it, let's say a tenth or a fifth of a percent away, you may be drawn to it and consolidate. Seeing these types of levels on a chart and being able to make decisions around them and others like it can help to take away some of the time that's otherwise involved with setting up these trades, while also being able to build in the confluence of options to other levels, like, let's say, volume profile, or looking at areas of the structure in the buy and sell deltas on the chain. This all can add to confluence. And one of the big parts of my trading is confidence through confluence. So I like to see multiple levels kind of telling me the same thing. The market has generated information that this price or somewhere around this price is really important. And options for me is a big part of that. It's not the only part. I'm happy to discuss some of the other dimensions we look at, but it is a big part of it. And here's why. For example, in the S&P 500, the index options, believe it or not, trade $1.3 trillion of notional every single day, with 60% of that volume on average expiring the same day and 75 to 80% expiring within a week. So looking at that near dated flow in an instrument that literally is the heartbeat of the global equity markets is undeniably a signal. And if you look at the futures, for example, which are still valid and relevant, they are trading at a fraction of the total notional versus the options. That is to say, the options market, especially in things like the S&P, really is the center of the market now.
So to dissect that a little bit more, in let's say a trader that is, starting to dig deeper into their process and develop things and get a little more granular as you have gotten. What kind of took you down this path? Do you like what type of background do you have, for example? Is there some math or some engineering, or are you just a very detail-oriented, turn over every stone kind of person to come to these? Because you're exactly right. In the options market, there's so many signals, and when you start to bring all those together and backtest, there's a lot of information, but that's outside of the ability of a lot of people. And so how did you get to that point of developing and testing like that?
Sure. And I love that question because it kind of gets to the heart of who I am as a person and as a trader and what value I bring to this community. So I have a blended technical and finance background, and I am detail oriented. I love drilling into areas where I'm very interested in teaching myself new subject matter, new skills. I feel like every day is a new opportunity to learn something and then apply it to improving the quality of our lives, our outcomes professionally and personally and otherwise. So that's where I'll start. And I'll say back in late 2021, it became blindingly clear, even throughout that whole year, how important options were for price discovery in the indices and in some of the most popular stocks. And so in my head already at that point was embedded this idea that there's this foundational shift happening. And there were luminaries like Jem Carson, who had been a big options maker in the S&P 500, that had spoken a lot about this and how they move the market. So I was fortunate enough to learn from some of his work, a big body of academic research that existed, and then my own discovery, just going in and trading them and really learning the behavior of these S&P index options in a more granular level. And that inspired me to start to look more at making tools, because what I saw was there was so much signal here. Obviously, there's a lot of noise, as with anything else, but there was so much signal here into how markets were repricing around these options. And let's talk a moment about why. Speaking of market making, if we go out and we buy puts on the S&P 500 index in size, a market maker has to hedge in size. And in doing so, we're not only asymmetrically increasing the impact we have in the market, because if we bought or sold the same amount of futures, that's going to have a lower impact than a high delta option where there's some implied leverage. So basically, if you're buying a lot of puts on the S&P, that market maker has to hedge that delta, that exposure they have otherwise. And so in near time, typically algorithmically, there will be S&P futures sold. So when you see a large amount of put flow hitting the tape and it's more than what you're seeing in calls and the market's already looking shaky, you might have some gravity down there because of that hedging flow and because that's where a lot of the price discovery in the index happens. So for me, seeing this play out time and time again, I realized there was an opportunity to build tools because for me, I will say I'm lazy in a productive way. If I can find a way to automate something that I'd otherwise spend a lot of time doing by hand, I'm going to do it, and I'm going to do it iteratively. I'm going to build the foundation and then I'm going to continue to improve on it until it really gets to a point where I feel like it's even production ready. If there's some value there, if there's a niche to address with it. So when I built the SPX options visualizer, it was with that in mind. First, it's, hey, I'm going to trade with this. This really helps my process. Then I started sharing it with members as a beta, like, hey, check this out. Look at it in a stream in real time. And then it was such a hit. I was like, okay, I'm going to make this into a product that is a data package for platforms like Bookmap and MotiveWave and otherwise, so people could actually start to see how these flows and positioning levels impact price discovery and trading overall. And so that's kind of where it started. It started off as really just having this appetite to learn, seeing shifts in the market regime, the dynamics as to what we're driving price discovery at the top level of the indices, but also in some of the really important stocks, Tesla, Nvidia, and otherwise, sometimes the most actively traded optionable stocks in 2021 really getting my attention, because you'd see those most active strikes, you'd see the stock ping those levels and then start to get pinned. And, you start to get the impression options are really driving the market here, and the commons and the ETFs and the futures, they're still involved. And there are days where they drive, but they're not driving as often as they used to.
That's great. And you have obviously dug very deep into all of this and developed some very interesting tools. What do you think, in this process, what do you think are some of the blind spots that the professionals, the hedge fund managers and the money managers of the world are missing in some of this? In building this process out, do you think that everyone, the pros look at similar things in different ways, or what are those blind spots?
That's a great question, Jared. And for me, and I do consulting on an institutional level, and I have for well over a decade. So I've seen inside shops of various types. I've seen hedge funds, pension funds, managed money, wealth managers, specialty funds, generalist shops. And I'll say it's very much diverse. There are some shops where, like the value guys that I still know and love and talk to, they just look at the fundamentals primarily. I have opened their eyes more to momentum and macro. They do look at them more than they used to. But if you're talking about the core of their process, it's always going to be fundamentals. And so that does, in a sense, open up a conversation. I think every shop has a little bit of a blinder on or a lot of blinders on, depending on their focus. If you're just a tech growth shop, you're really just focused on those trends, and you may miss out on the broader momentum trends. You may miss out on the broader macro picture that can both help you to get in a little earlier and out a little earlier and benefit your overall returns, just as one example. If you're a more actively trading hedge fund, and I've talked to these folks and worked with them and been in their shops, I notice a lot of them are still not paying enough attention to the role that options play in price discovery, or the magnitude of the impact that retail can have on price discovery, and especially as it pertains to narrative driven trends. And we talked a little bit earlier about parts of the market that have these frothy, irrational valuations. You start to ask why. Well, one of the reasons, and I'll tell you, I see this play out time and time again in the metrics. You get a bunch of guys in hedge funds who are right about the long term, but underestimate the power of the narrative in the short to intermediate term. So, for folks out there listening that may not understand, most hedge funds are going to have some kind of strategy that's long short. That's the idea of hedging. But what often happens is, while they're right on the fundamentals, like, for example, quantum stocks, most of these are going to be zeros. If you have a long enough timeline and you're not putting too much capital at risk, the hedge funds that are shorting them will probably make money on those trades in the long run. But in the short run, what often happens, as one of many examples like this, is too many different funds get too concentrated on shorts. The shares become harder to borrow. The fee to borrow them goes up, kind of juicing some of those shorts. Some just have to mechanically cover as a result of that. But then you have a catalyst, whatever it might be. Maybe it's a headline. Maybe it's an off the cuff remark from Jensen Huang about quantum being closer than he thought. Maybe it's, something else, a development that sounds really great on paper if you don't understand how far the actual premise of this tech being used in production is in the future. And so the space rallies by 20, 30, 40, 50% in a week. If you're concentrated in that short as a way to offset the leverage that you have in your longs, and on the other side of that, even worse, the long side of the book is under pressure because it's largely, in areas of the market that are succeeding. Let's say an example of a lot of hedge fund balance sheets are long Mag 7 and short some of these lower quality small cap stocks. That trade works really well until it doesn't, and sometimes it can go violently bad. So here's the example of a doom loop. You've got the NASDAQ down 3%. You've got quantum stocks up 20, 30, 40% because of some sector-specific headline. All of a sudden, the risk manager's tapping someone on the shoulder in the fund saying, you've got to delever here because you've got your longs working against your long book. You've got your shorts working against your short book. And so you see some forced deleveraging add to both sides of that pain trade for other funds. The quantum stocks continue to go up because there's forced buying. The Mag 7 continue to go down because there's forced selling. I think one of the biggest issues that I see in that space is too many people kind of using the same vehicles, and they become what we call hedge fund hotels. And then other traders target those. Now, the Mag 7, obviously a lot harder to target that. It's many, many, many trillions of dollars. It's one of the biggest parts of the market. But when you look at the short side of the book, where people often get overly focused, that is a very easy side to target. And options give you the asymmetry or the leverage to make a bigger impact. And here's where retail is underestimated. And I keep seeing these episodes. And so I'd say the one area is to really be mindful of those shorts against narratives that, for example, retail loves, or just when you see a small float stock have over 20% short interest, and all it takes is a small little catalyst, a headline, something to juice it. And then all of a sudden there's momentum buying, forced covering, and a, kind of a doom spiral that starts to take place there. So it's like shop specific, just like pensions. I feel like have been really hesitant to get too involved in the commodity space until more recently. I feel like diversifying for longer term returns, if you're going to be trying to deliver 8% year over year, you need to have a momentum meets macro strategy to get into other less correlated parts of the market. Obviously, in a horrible bear, correlation to everything basically goes to one. But in most trading conditions, it's not a horrible bear. And there's other parts of the market to produce gains if you're a more generalist shop. So I know I've gone through a lot, but those are three examples that I'd say I see with some degree of regular cadence.
I think that's interesting in that certainly the meme stock craze of 2021 really took. I mean, you probably heard the same thing as much as I did. You know, the retail traders are the dumb money and so on and so on. And then 2021 hits, right? And retail traders drive these stocks through the roof, and hedge funds just get absolutely steamrolled
Yeah.
and take these take these gargantuan losses in that space. And so so that's those are all interesting points. And I think that as hedge funds are always interesting, right? The it's almost like the bigger the fund, the more generic the play becomes, right? I mean, if you've got $50 billion under management, the odds that you own SPY and Nvidia and Microsoft and Meta are pretty high that you own them at scale, right? And I feel like, as you're kind of saying this, I feel like so many hedge funds have kind of lost the ability to be creative and to really chase down alpha. I mean, sure, you buy Mag 7 stocks the last several years, great. It's all been great, right? And maybe creativity is not warranted in that space. But these hedge funds feel like, especially the larger they get, that they miss the opportunity to put the brains and resources that they have to work. And maybe the resources are too great and the brains are too complex, right? To find that creativity in there to really understand the narrative. Because I mean, obviously there's nuanced elements to that, but I think that's kind of where a lot of it has gone, and the hedge funds have missed a lot of the short squeeze opportunities, or some of these meme stocks, or whatever it may be. And so when we talk about that, it just makes me think about crowded trades. It feels like that is the market that we're in. It's crowded trades galore. There's a lot of caution around the crowded trade. And how do you think this plays out in the overall market, the hedge fund community? Everybody kind of owns the same stuff and large amounts of it.
Well, first, I want to say I really like what you said overall about how some of these funds have become so large. It's sort of like an economies of scale question. What can you buy with that much money without A, completely distorting the asset class and having too much concentration risk, and B, really to be able to continue to do what a lot of funds have to do, which is chase benchmarks and have returns that keep the clients invested and willing to pay those fees. So I think that is a big problem. You definitely have less alpha being able to be generated when the funds reach a certain size. And I think Buffett said it was so much easier for him to make his first millions than it was for him to make his first billions, because back then, you could bet on a small company that you really felt with conviction was going to grow. But as Berkshire Hathaway became a multi-hundred-billion-dollar asset manager, and that's really what they are, you could call them a conglomerate, but they're really a very smart asset manager. It's become a lot harder to do that. And they've still managed to beat the S&P, but that takes great skill at that scale. And so I like that you nailed that point, because I'll say it's not through any fault of lack of brain share in any of these types of shops. I've met some of the smartest people I've ever met in different parts of finance. And so it really has to do with that. And it also just has to do with being focused on certain things. Like if you're an equity shop, US equity shop, there's really only been, 50 names in the S&P to own over the last 5 years. And that's kind of set this idea of we could just ignore the rest of the market, just focus on this stuff, and then hedge a basket of stuff we don't really like too much. And so I do think as we shift gears here, we are seeing a market that is incredibly crowded. It's incredibly crowded in some of the narratives like AI, like quantum. It's incredibly crowded in some of the other plays that we've seen where there's been just so much focus in crypto over the last year that I feel like a lot of that stuff is getting, I wouldn't say it's back to the NFT mania days, but it's not terribly far away from it with where expectations are versus the reality that would be necessary to drive things to those extremes. And then we're starting to see signs, although I don't think we're quite all the way there yet, that precious metals are getting a little more crowded. It's certainly become something that everyone's talking about, especially gold. But if you look at positioning, it's not quite as stretched as we've seen during prior manias. So I'd say that we're certainly closer. I would say that with AI in particular, this is one of the three pegs of the economic stool narrative that I would say we have right now, which is, AI and the capex expansion that's happened and is planned to continue to happen is a major part of what's driving U.S. Economic expansion. Government deficit spending, which is near the highest levels it's ever been with unemployment this low, is another peg, and that's been going on through multiple administrations. It's very bipartisan because there's a tacit acknowledgement in the government that if we slow this down, we're going to have a difficult time in the economy. And then the third peg is the affluent consumer, accounting for 50% of consumption trends from just the top 10% of earners, because those wealth effects are translating into this idea of spending it into real world goods and services. So, with any of the three pegs of that economic stool in threat, you could have a really troubling time in the markets, and then that could translate to the broader economy. And in the here and now, it's the disconnect between where AI is being marketed. It can just replace people. You don't need humans anymore at work. And where AI is really, which is that generative AI has made a lot of impressive progress, but it remains an intelligent token prediction engine without the wherewithal to know what it's being queried or what it's telling you, which also means it doesn't know what it doesn't know. So it can just hallucinate things that it doesn't know based on probabilistic relationships in its data. So is that going to replace employees at scale in blue or white collar industries? No. Can it be, with proper guidance, supervision, and specialization, a force multiplier for productivity? Yes, but that's not how it's marketed. And that's not what all this sort of CapEx narrative is built on.
Which brings us to a very, I think, hot topic in the AI space and everything. And to speak to that point a little bit, Ken Griffin from Citadel recently said, AI is doing nothing for us to increase alpha. It's helping productivity, but it's doing nothing for us in that trading space, right? And that was, I think, a shocking announcement. Here at my own hedge fund, we have a quantitative arm, and we put a lot of time and energy and resources into it. And it's interesting. I think you're exactly right. It's being marketed in a slightly inaccurate way, to put it mildly. But that's a massive discussion and topic. But talking about AI and how much of a yeah, I mean, the last numbers I heard was AI has been about 40% of the GDP over the past 12 months. AI related development and CapEx and so on. That's substantial. So is AI a concern for you as a potential market catalyst? What is the most concerning sector of the market or element within the stock market or the economy as a whole that could cause trouble?
Absolutely. And I like that question because it kind of gets back to that three-legged stool of the economy. AI is a huge part of that that's been supporting the growth of this economy. And I think that it's more than probable that there's a number of changes that we'll see in the future about how this plays out. One is the scale. The amount of expansion that has been planned and discussed is unrealistic and unnecessary at that scale, in my view. And this is an informed view based on several different trends, one of which we've talked about a little bit. that we're not seeing the aggregate productivity gains or labor replacement, that grandiose dream that it was supposed to bring, that it is being marketed as capable of. Another component is the era of efficiency. And I've talked a lot about this over the last, I would say, 9 or 10 months, that we've seen this year alone what used to have to run in a data center scale rack of GPUs, you can now run on your desktop. You can run
Right.
smaller models that are more powerful, and you can do so on GPUs that you can buy for workstations or even for gaming. You can string them together. Not only does this improve security and privacy, but it gives you full control over the quality of your experience. And in many cases, you'll save money over the long run. But what's most important is to go from needing, say, 250 gigabytes of video memory to just needing, say, 50 or 24 or whatever to accomplish similar level tasks. That's transcendent, and that's models becoming more efficient for training them with better structure, so you can train them on 15 trillion parameters and still create a model that fits in, say, an 8 gigabyte video card. Granite from IBM, Granite 4.0H, recently showing that this is an open source MIT licensed model that anyone can use on their own infrastructure. So I would say that there's a lot of things that are happening with efficiency of the models themselves that reduce the need for increased GPUs and overall infrastructure. But then there's also elements like there are lossless or very low loss levels to the precision of the model of quantization. And what that basically means, if you know about image compression and you compress an image too much, it doesn't really look very good, but you can get to a sweet spot where you save space and the image still looks good. It's the same thing for AI models. You're basically increasing the efficiency of them by reducing the amount of space they take, and in doing so, reducing the amount of compute and memory they require to run. Well, we've seen huge gains in that area of AI as well, which means that, what used to be a model that you'd have to run at 16-bit precision, now you might be able to run at 5 or 6-bit precision with, say, an unsloth dynamic quant or quantization awareness training. That means that the model still performs like a much larger model, but you can use it on consumer grade hardware, or at least a lot less in the data center. So that's another area, efficient models, but also efficient high quality quants. And then you're also seeing the hardware. You're seeing more hardware for AI becoming more efficient and also becoming more specialized. So I think that those are three powerful areas, and that's just of many that are growing, that pose a threat to having to build so much compute. And I would say that in terms of CapEx spending, you kind of go one of two ways. You either just overbuild and ignore the reality that's in front of you, or you start to see companies saying, hey, wait, we're not really monetizing this at the scale we were hoping. For example, Oracle saying they're losing money on every Blackwell GPU that they rent out. And
Right.
you start to see investors push back and say, we'd like you guys to kind of pare this back. We don't need to have, a race without an impetus behind it. That is to say, if there isn't that growth, particularly in the bottom line, why are we spending so much money? That to investors, they might say it's better going into buybacks, and buybacks are dropping as a result of AI capex. So there is a give and take here. So I think there's a lot to be explored. That one peg is important. The other peg is the government deficit spending. I don't think that's going away anytime soon, but I think it's going to become less impactful as you see some of the subsidies that help some of the less affluent components of society engage in the economy coming away, whether it's in healthcare or SNAP or otherwise. If folks can't afford to get healthcare or pay rent or put food on their table, there's going to be more stress. And you're seeing it in really high levels of delinquencies in lower grade tranches of auto debt. You're seeing it start to pick up in student loans and credit cards. And I'd really be concerned if it starts to pick up in mortgages and prime auto debt. We haven't seen that yet, but it's an area to watch. And the final peg is the wealth effects. Well, if the market starts to realize that the AI narrative is more tenuous than it thinks, then you start to see a corrective impulse. And back in Feb to April, when it was trade tensions, affluent consumer spending started to diminish pretty quickly when they saw those monthly statements coming down and their portfolios were, under some pressure. So that's another risk, because that's a big part of the economy, is all that top 10% accounting for 50% of consumption. If they check out, then that's going to be another area where we start to slow down, or maybe even we see some degree of recessive growth. So I think that we are in an economy that's very K-shaped. It very much favors large companies, big government spending, and affluent consumers, and that makes it more concentrated and more at risk.
That is that is very interesting because first of all, your point about the AI being a little bit different than what people are kind of expecting is as far as, there's a lot of discussion about how expensive it is to build these data centers and how much resources are actually being put into this and what AI actually produces. And it's an interesting point that as AI improves, because that's one of the big issues, right? Is you install these chips and these data centers, you get everything running, and by the time it's all up and running, it's time for an upgrade, right? The next newest, greatest thing has come out, and so I think that's where a lot of brains have been, toying back and forth between what are we what are we more concerned about? That AI is not what it is cracked up to be, or are we concerned about the finances of AI in that we're overbuilding, right? That we don't need the amounts of resources to run what we need to run, and so that's an interesting point you bring up, and certainly the affluent consumers, they've been quite resilient, but it's funny how market sentiment can change in a moment. The government's the government, right? They continue on and they'll do what they do. But I definitely those two kind of pegs, as you say, are very interesting. So I think that's some great insight. Final word. What do you think about gold? What are your thoughts?
So gold to me, like we were talking about a little earlier, is this pure play on psychology and momentum. And one of the biggest catalysts for gold for me has always been uncertainty. I know it's often seen as a hedge against inflation, and I think to some degree you could argue that that is the truth over very long periods of time. It often takes time to catch up to money supply growth, which is perhaps part of what's driving it now. But I think no small part of gold's rally is also driven by increasing uncertainty. Uncertainty about the sustainability and durability of Western hegemony as we know it. Uncertainty about the fiscal trajectory of various governments around the world, including that of our own. Uncertainty about what money is going to be worth 5 or 10 years ago, 5 or 10 years ago versus now versus 5 or 10 years in the future, and how that debasement effect, which is really a big driver of this, the whole debasement trade, could also continue to drive gold higher, but also uncertainty about global geopolitics, uncertainty about domestic politics, and overall uncertainty about the economy. I think all of that drives people into gold. But there's another area of uncertainty that's in the macro view of what happened when Russia invaded Ukraine. The West once again weaponized the dollar and SWIFT and other components of the Western financial system to punish Russia. And what that does to every other country that holds dollars and assets or transacts in dollars, it makes them want to hedge that bet. Doesn't mean they're going to just de-dollarize, but it does mean they'll be more tempted to buy gold than to buy dollar denominated assets like treasuries in their central bank and other balance sheets. And that's exactly what we've seen over the past, say, 3.5 years. Much more central bank buying of gold, much more sovereign buying of gold, much more investor buying of gold, now even starting to take root in the US, which is dramatically underallocated to gold on a portfolio level. So I think that all those factors that have driven gold as far as it's come are still very much intact. But I would also caution that any time, and I've traded gold and silver almost as long as I've traded equities, anytime these instruments start to go parabolic, that leaves behind very poor market structure. You really want to see them move up, consolidate, move up, correct, move up, so that you have defined areas of support where buyers can come back in, where you have healthier market structure. In the later part of this move, we have not seen that. Now we're starting to see a pullback today. It's actually the biggest pullback in gold by percentage since the COVID crash. I would hope that this brings about a corrective rinse out of some of the weak hands that have gotten late long gold and of some of the folks that are just purely trading on shorter term momentum, so that we can have them buy in at higher prices if and when this turns back around. I still think gold can hit $5,000 an ounce next year and silver can hit $72 an ounce. But I do think it would be extremely healthy to just have a few months of boring sideways chop to kind of consolidate these gains, build some healthier market structure, and continue onward and upwards. It's not as if all the factors driving the uncertainty or the global debasement of purchasing power are just going to go away. If anything, they're likely to intensify from here. So if we can flush out the specs, shake those weak hands out of gold, I think that's what builds us that next leg of the rally.
Well, that's very timely. Gold is down about 6% today, so I think some of that early shaking is starting to happen. But it is interesting. When we get to that point of no price is too high is usually a pretty interesting place to not be involved for sure. And gold feels like it's kind of gotten to that place. Let's just keep buying, and then we have a decent down day today. I wouldn't say it's a huge one, but it's there. There's some of that early shaking beginning.
Yes. And what
So
two things I'll leave for you and your listeners on the gold front since we're capping it off here. First, watch the 20-week moving average on gold, 20-week SMA. That has been a consistent rebid zone pretty much over the last 2 years. We get back down there, we kiss that 20-week moving average, and if we test below it, we typically get pulled back above. I'd love to see a head fake where we get pulled below, we zoom back above. That would be a powerful swing buy signal for me on a momentum time frame with back testing looking back at several years. The other area that you want to look at for gold and things like Bitcoin are Bollinger Bands. And it's not the conventional way of looking at them. It's what's called a squeeze to breakout. Basically, what happens is you get a period of consolidation that leads to bands squeezing together, and you have a period of volatility expansion, and that leads to the bands spreading apart. We want to continue to see that Bollinger Band expansion and gold staying above the 50-week moving average to say that expansion is still intact and favoring bullish price discovery higher. So those are the two metrics. Watch the 20-week as your near-term momentum indicator. Watch the 2.1 standard deviation on a 50-week Bollinger Band for the continuation of that band expansion if you want to trade gold like the pros.
that's great. I will include some charts to illustrate that. Those are some great tips. And thank you so much for sharing so much. You're very well versed in all things market. So this was a great discussion, and we appreciate you joining us today. Tell everyone where they can find you and follow you and get some more information about everything.
Absolutely, Jared. And thank you so much for having me. I appreciate it. This has been a great conversation. To learn more about me, you can follow me at Mayhem 4 Markets. That's Mayhem number 4 Markets on Twitter and YouTube. To learn more about my work, visit traderaid.com, macrovisor.com, and marketsandmayhem.com. Thanks, everyone.
Excellent. We'll include those in the show notes. Thanks again. Take care.